thank you everyone for showing up today for this quarter's economic update. Aptly named A Good Year Ahead. In the coming slides, I hope to show you why we think it's going to be a good year ahead, the major economic and leading indicator evidence that supports that claim, and then also move into some of the risk factors that we're looking in the longer term as we move through the end of 2018 and into 2019. Just to give you some context, I'm going to be primarily focusing on United States economic trends, but I'll also be touching on some global and international trends as well. Before diving into the meat of my report, I like to always go over the kind of terminology and methodology that we here at ITR Economics use. Some of it can be a little bit heterodox compared to some other major economic and forecasting firms. And so while I know that many of you have listened to us speak before, I'd like to spend just a moment with a brief refresher and kind of a crash course on how we here at ITR define these different metrics in the business cycle in general. So when we're going through these different slides, you'll hear me talk about two primary different metrics that we use to determine an industry or company's position within the business cycle. First, we have our data trends. These are monthly moving averages or moving totals. We use moving averages when it doesn't necessarily make logical sense to sum up something. For example, an index or a percentage. Those aren't things that you would logically add together. However, sales or shipments or revenues, we would use moving totals for. Our primary data trends or moving totals are the 3 MMT and 12 MMT. That's the quarterly and annual moving total. Obviously, just the sum of the most recent 3 months of data for the 3 MMT and the sum of the most recent year of data for the 12 MMT. It's important to note that you'll hear me use those terms, 12 MMT or annual total, interchangeably, but they mean the same thing. Conversely, we then have our rates of change, and our rates of change are analogs to the data trends. We have our 312 and our 1212. Our 312, or quarterly rate of change, is calculated by looking at the most recent 3 MMT, so the most recent quarter of data, and comparing it to the same quarter 1 year ago. So the June 312 would be the rate of change between the June 3 MMT and the June 2016 3 MMT. Conversely, we have our 1212, or our annual rate of change, which is simply the most recent year of data compared to the year prior. The 1212, or annual rate of change, is the metric that we use to primarily determine where an industry is within the business cycle. And it's the most common metric that you're going to hear me talking about in this report. So again, if you hear the 1212 or the annual rate of change, or if perhaps I'm just talking about growth rates in general, chances are I'm talking about this 1212 annual rate of change. Now, if you move your eyes to the bottom of my screen, you can see this little, four-colored sine curve that I have here. And this is a graphic representation of the business cycle as we define it here at ITR. If you've ever taken a business course or an econ course, this isn't going to be anything surprising for you, but I'm going to go through explicitly how we define it so that when I use our shorthand, we're all on the same page. The first phase of the business cycle is in that bottom left-hand quadrant in blue. That's phase A, recovery. This is what I consider the light at the end of the tunnel phase, and it's when your 1212 is below zero, so the industry or your company is contracting on a year-over-year basis. However, that 1212 is moving up towards the zero line, signifying that the pace of decline is getting slower and slower and slower. Hence the light at the tunnel, because when that 1212 crosses that zero line, you've transitioned to phase B, accelerated growth. Phase B is, the best phase of the business cycle. If we had over it, it's where we would be at any given time. Phase B is defined as when the 1212 is above the zero line and is rising. We're expanding on a year-over-year basis, and that pace of expansion is accelerating. Once that 1212 peaks, we move over to the top right-hand corner, and this is phase C, slower growth. During phase C, slower growth, the 1212 is above the year-ago level, so we're expanding on an annual basis. However, the pace of growth is slowing, right, as that 1212 falls back down towards the zero line. I like to consider phase C the cautionary phase of the business cycle. It's still a positive phase of the business cycle. You're still experiencing growth. Sales are up, profitability is good, things are good in general, but it's really where a lot of managerial prowess can come to shine, because this is when you have to make a lot of hot button issues. Primarily, as that 12-12 is declining, you're approaching a late phase C. Are you going to fall into phase D recession and enter a period of contraction? I don't have to explain what a recession is to you. Or are you going to have what we call a soft landing, where that 12-12 reaches a trough and begins to rise again, all without crossing that zero line? So will you transition back to phase B, accelerating growth, or will you fall into phase D, recession? That's important to note as a manager or as a sales team, because as I'll get into in a little more in depth later on in this report, you have very different management objectives or managerial strategies that you need to employ in order to realize your full potential as a company if you're expecting a hard landing or a soft landing. At any given time after this report, if you've got any questions with the terminology or the methodology, and you don't want to email me or reach out to Courtney, I encourage you to come back to this slide because it is a good primer on what we do here at ITR Economics. So without further ado, we're going to jump into U.S. industrial production. Now, what you're looking at on this chart, on the left side, we have our data trend, so our 12 MMT, and that is the overall level of production within the U.S. economy. You can see in dark blue, that's the historical actual data, and on the right side where you see these light blue jagged lines, those are our forecast expectations for the industry. On the right half of your slide, you have that kind of snake chart, and those are 12-12 annual rates of change. Again, in the light blue on the right side of that, you also have our forecast expectations. This is a pretty standard way of presenting a lot of the different industries that we'll be looking at today, so it should become more and more familiar to you as we move forward. So U.S. industrial production is what I'm starting off with in this talk because it is one of our primary benchmarks for the U.S. economy as a whole. Oftentimes in the news, you'll see GDP lauded as kind of the end-all, be-all when describing growth within a nation. However, here at ITR Economics, we found that a lot of our clients, especially in the industrial and manufacturing space, relate to the business cycles of the U.S. industrial production much more closely. So this is kind of, again, one of our benchmarks and what we use to describe many of the world's major and foremost economies. Industrial production has three main components: mining, manufacturing, and utilities. And of those, at this time, both mining and manufacturing are in cyclical rising trends, while we're seeing some early signs of weakness in the utility space. Overall, U.S. industrial production is up 0.8 percentage points year over year, so that's no growth to write home about. We like to see growth in the 2 to 3% range. However, after a pretty severe industrial recession that we saw in late 2015 and the majority of 2016, this is good news. Since our last report 1 quarter ago, we have seen significant rise taking hold, and we expect 2017 to finish up 2.2% year over year. 2018 is going to be characterized by some slower growth, but still positivity, finishing the year at about 1%, before we fall into an industrial recession in 2019, ending the year about down 1.2 percentage points year over year. Throughout this report, I kind of want you to keep that forecast profile in mind. We're expecting phase B accelerating growth through 2018 and into early 2018. 2018 is going to be a good year, but growth will be slowing, and 2019 is going to be recessionary. Those three major trends right there are going to be recurring and characterizing a lot of the outlooks we have for a lot of disparate segments of the economy. So if you can keep that phase B to phase C to phase D transition over 2017, 2018, and 2019 in mind, that's going to help give you a lot of contextual understanding here. A lot of the growth we're seeing right now is being driven by two main components. First, fairly strong consumer trends. Consumers have been enjoying, secure labor market, moderately rising wages, and because of that, they've been spending money. Meanwhile, a lot of the negative headwinds from the crash in oil prices and the crash in metal prices that we see last year have receded, and that improvement in the mining economy is giving us some of this nice lift. But it's important that when we talk about our forecast expectations, we don't just give you these numbers and ask you to take it on faith. Instead, the pillar of our work here at ITR Economics is based on leading indicator analysis. And what that is we find a handful of different industries or indexes that lead different parts of the economy. And what that means is that, for example, if here we have U.S. total industry capacity utilization rate, and this is an index which attempts to describe how much of the U.S.'s total machinery is being used at any given time. It's an index that describes how much slack there is in the economy and how much potential for growth there is. It leads U.S. industrial production by between 9 to 12 months. So what that means is that when we see a turning point in the U.S. total industry capacity utilization rate, the utilization rate is in orange, we expect to see a reflexive move in U.S. industrial production 9 to 12 months later. Again, we've seen some significant rise here, and the utilization rate is supporting our expectation of accelerating growth throughout the remainder of 2017. It did peak late this summer, supporting our expectation of an early 2018 turnaround for U.S. industrial production. Similarly, we have the ITR leading indicator. The ITR leading indicator is a proprietary leading indicator that we here at ITR maintain on a monthly basis, and it's created to lead industrial trends by about 1 year on the median. Correcting for that lead-lag relationship, again, you can see that it supported that 12-12 turnaround that we saw in 2016, and is signaling strong growth in the U.S. industrial sector through at least early 2018. Oh, and this one doesn't want to move over on the right, so you're going to have to, you do some mental gymnastics and take my word for it. But here we have the U.S. Purchasing Managers Index. The PMI is one of the primary leading indicators that we look at here at ITR, that many other firms look at, and that often comes up in the news if you read the Wall Street Journal or the New York Times or watch Fox News. The reason that the PMI is such a great leading indicator is because it's not speculative. Instead, it is created by the Institute for Supply Management on a monthly basis. And what they do is they send out a survey to thousands of the U.S.'s largest manufacturers, and they speak to their purchasing executives and ask about current market conditions. So they ask about real-world, quantifiable economic trends like how are your sales, how are your orders, how is your backlog, how are your inventories, things that aren't taking into account uncertainty or speculation. Because of that, it tends to very reliably lead the U.S. industrial sector. It turned over about 4 months ago, which corroborated our expectation of an early 2018 peak. But if you look on the right on that orange line, it did jump back up for 1 month before curling over. Now, this is overall a positive trend for the U.S. economy, signaling that we might actually see a little bit more acceleration within the U.S. industrial sector past the first quarter into the second quarter or so. Now, again, when we look at leading indicators, it's important to look at a basket of leading indicators, because at any given time, one single indicator or one single industry may be giving off some false signals or doing something erratic. But if the Purchasing Managers Index is telling the truth, it does shake up the timing of our 2018 expectations a little bit, but overall it suggests that things could be better for longer. So good for you and ultimately good for me. Now that we've had improvement in the mining sector, again, rising natural gas and commodity prices and all of those strong trends, we've finally seen U.S. non-defense capital goods new orders transition to Phase B accelerated growth. Non-defense capital goods new orders is kind of an archaic mouthful of a term, but as an economist, one of my jobs is to make things confusing, so you have to come here and listen to me. But all non-defense capital goods new orders is capital investments, B2B activity. You can see it was depressed for almost 2 consecutive years, and this is primarily due to the relatively weak pricing environment that we saw. As steel prices stayed low, as oil prices crashed in 2015 and 2016, prices dropped, and manufacturers just didn't see a large enough return on investment to justify large capital expenditures. I'm talking about, $400,000 pieces of mill equipment, $600,000 combines on a farm, those very large capital-intensive purchases that normally have to be paid off over 1, 2, even 3 years. The pricing environment wasn't strong enough to justify purchasing on a large-scale level in the U.S. But finally, as we have seen those prices recover, we have seen capital investment pick up. Capital investment normally leads the industrial sector by about 2 to 3 months. So if you have a strict timing relation to the industrial sector at your own personal company, then you should see this capital spending give you a nice little boost in the next quarter or so. And now, as I mentioned before, U.S. industrial production is kind of our primary metric for looking at the economy, but it is important to look at gross domestic product as well, because it is the most holistic capture of economic activity within any country. And we spoke briefly about some of the weakness that we saw in capital investment, the weakness that we saw in the energy sector, and that recession that we looked at in 2016 for U.S. industrial production. But if you look on the left here at this data trends, where you see the dollar value of the U.S. economy, it has been growing consistently since 2008. That line is going just up and to the right, which is what we want to see. Similarly, the rates of change, while they have slowed at points and accelerated at points, have been consistently above the year-ago level since 2009 or so. And that right there poses kind of a conundrum, right? If we've seen all of this industrial weakness, if we've seen a crash in the mining sector, if capital investment and business-to-business activity has been depressed, where is this growth coming from? What is driving this kind of overt positivity that we've seen for almost 10 years now? Well, I'll tell you right now, it's the U.S. consumer. Here's a chart that I like to show whenever I speak. It's U.S. GDP broken down by consumption into the 3 kind of largest, most general baskets. You'll see 16% of the U.S. economy is comprised of business investment. So that's that capital goods figure I showed you that has been down. Government spending is 17%. Well, we can always expect the government to spend, so that's always going to give GDP a nice boost. But then 67%, over 2/3 of the U.S. economy, is comprised of personal consumption, which is what we do at restaurants and bars, at Target, at Walmart, at Best Buy, on Amazon. It's just U.S. consumers spending money. So 2/3 of the economy is driven by this personal consumption metric, which really does suggest that, as long as the consumer is healthy, the U.S. economy is going to be healthy in general. So let's take a quick look at what the consumer is doing. Well, when it comes down to looking at consumer health, one of the first things we want to look at is the job market. Here you can see we have U.S. private sector employment, and this is in millions of jobs. Again, since about 2010 or so, private sector jobs have been rising, and they're actually at record high numbers right now. Employment growth is slowing. It's up 1.7% year over year. So that's not a great employment growth metric, but it's healthy. It's moving up, which is what we want to see. More importantly, job openings are in phase B, accelerating growth, and they're up almost 3%. So anytime you see job openings outpacing employment growth, the first thing that should come to your mind is that's going to be a tightening labor market, right? There are more jobs opening up than there are being filled. Again, that is good for the U.S. consumer. That's going to put upward pressure on wages as firms have to compete more kind of fiercely for labor. And as that's happening, the involuntary part-time employment metric, you might also hear it called part-time employment for economic reasons, is down 8%, over 8% in phase D. And what that is it's saying that while more people are moving into the U.S. economy, more people are being active participants in finding jobs, fewer people are being stuck with part-time jobs while they want full-time jobs. And that's good because obviously, in general, even having multiple part-time jobs is going to come with less compensation and fewer benefits, than a steady, stable, full-time job. At the same time, the quit rate is rising, and that's just the average time it takes a U.S. consumer to quit their job. And so that seems kind of counterintuitive, right? If we have more people entering the workforce, more people working, but also more people quitting. And while that sounds strange, that's often the case with economic trends, with this kind of two sides to the story. And what's happening here is that as the labor market is improving, as firms are offering more money, higher wages, better benefits, better working conditions, consumers are saying, well, you know, if unemployment is at 4%, when I remember it being at 9% at one point, I'm confident that I can get another job. So I'm willing to quit the job I have at ITR or at one of the CBSA companies, and I'm willing to go take a chance and move to that city I want to move to, or, you know, move to the suburbs to raise my kids, or go try and find a higher paying job. Essentially, the risk of unemployment is so low right now that we're seeing more people quit their jobs to look for better ones. Now, that's great for the U.S. consumer, but as an employer, I hope you're thinking, that doesn't look great, which is true. Again, a lot of these strong consumer trends, rising wages, higher quit rate, that's going to have a negative effect on hiring, right? Your hiring windows are going to be extended. There's a smaller pool of labor for you to look at. Your labor costs are going to rise. And that's most likely characterized, if I had to guess, 2017 for many of you, and that labor market isn't going to change dramatically through at least 2018. Skilled labor is going to remain scarce. Wages are going to continuously increase, and because of that, you're going to see some downward pressures on your top line. So you want to be careful of that about interpreting this data. Yes, it is an overtly positive thing for the U.S. economy, but it also comes with some managerial difficulties that you'll have to wrangle with, and we'll get to that later. Graphically represented here, U.S. median weekly earnings. Again, up and rising. It ticked down recently, but as you can see, it's very seasonal and very cyclical. Tends to tick down every 6 months or so. But the pace of decline is actually slower than we would normally expect, showing that there still is a lot of gas left in the economy, a lot of room for absorbing new workers, and that those earnings are likely to rise and be at record levels, again, as you're budgeting for labor costs through at least the remainder of 2017 through early 2018. And now I have a graph. Again, one of the things I like to do when I give these webinars is to show you two slides that are seemingly at odds with each other. So I talked about rising wages, I talked about expanding manufacturing growth, I talked about expanding employment. But now here what I have is the U.S. private sector employment compared to manufacturing employment. Manufacturing is this snake chart in green, while overall private sector employment is in orange. And you can see one has declined precipitously since the 90s, while the other has been, aside from recessionary periods, continuously expanding and at record levels. And this kind of corroborates a narrative that you hear a lot in the media, right? Again, if you read Wall Street Journal, watch the Fox News, NBC, any of them, they'll talk about the death of American manufacturing, right? About us losing jobs overseas, about manufacturing being a husk of what it once was. And this chart seems to show that, right? We have less than half of the workers employed in the manufacturing sector that we had in the early 90s. And that doesn't seem like a good sign. But at the same time, if you dig a little bit deeper and ignore that narrative for a moment and come with me, here you can see that we have total manufacturing production, and it's nearing record levels, almost on par with where we were at the run-up to the 2008 financial crisis, well above where it was in the 90s when you saw that chart declining precipitously. So again, seemingly at odds with each other. But what it's saying is that the U.S. economy, the manufacturing sector in the U.S. economy, is not a labor-intensive manufacturing sector anymore. As we industrialize, as we nationalize, we've moved well past that. Labor-intensive manufacturing economies are what you'd expect to see in Mexico, what you'd expect to see in China, where they employ large amounts of low-paid, unskilled labor, kind of like what you used to see prior to the run-up to World War II in the U.S. Instead, we are a capital-intensive manufacturing sector, right? We use a smaller pool of workers who are higher skilled and higher paid. Meanwhile, we couple that with a larger amount of more expensive, kind of more high-tech equipment. So when you look at this chart, when I bring you back here and you look at the decline in the manufacturing employment and the loss of jobs and, again, the death of the manufacturing sector in the U.S., I want you to bring your mind back to this chart, that the U.S. is still one of the dominant manufacturers in the world. We're still making as much stuff, we're still producing as many goods as we really ever have. And again, that's not likely to change in the near term. So that narrative about the death of manufacturing is misleading at best and flat out wrong at worst. And most importantly, I'll bring you here, what we have on the left, we have the 2016 Global Manufacturing Competitiveness Index. That's in green. And on the right, we have the 2020 projections. And what this does is it tries to aggregate all of the factors which influence how competitive different nations are at producing goods on a large scale. You'll see in first place with a perfect 100 index, we have China, followed very closely by the United States, and a little less so than Germany. Those three, China, United States, and Germany, comprise the three kind of most competitive countries in the world. Now, it's a little surprising, a little unfortunate that China has barely edged us out to be the most competitive manufacturer in the world. But if you look down on the bottom left, you'll see that the Deloitte, who created this index, found that talent was the single most important driver of a company's ability to compete on a global stage. So how many workers do you have, and how skilled are they? How educated are they? How willing to work are they? So after that, we have cost competitiveness, right? How cheap are your goods? Can you undercut the competition? Right now, what gives China the edge over the US and Germany is that cost competitiveness, right? They pay their workers much less than they do us. They have much fewer benefits, longer working hours, and that helps them get that perfect 100 score. However, as we said, in the long run, talent is what determines a country's competitiveness. And by 2020, we are expected to take back by a much larger margin than we have now, the #1 global manufacturing competitiveness trophy. So again, look at the long-term demographics, right? We have a higher skilled country. We don't have to deal with rising wages as fast as China or Southeast Asia does, because we've already matured to that level. Look at these factors, these competitive factors. Look at the fact that as a country, we do more with less, right? It takes fewer workers to produce more goods, and very much so when you hear that death of American manufacturing, it's really just the evolution of American manufacturing. And now with the developments in the past month, as we talk about manufacturing, as we start looking at energy prices in the energy sector, we have to ask ourselves, what about Hurricane Harvey? What does this do to our economic outlook? What do all of these different hurricanes that have ravaged the Southeast do? And obviously, the loss in life and the loss, in treasured possessions is incalculable. It's a tragedy through and through. But as economists, we're known as kind of the dismal scientists, because our job is to aggregate and put a dollar value on the effects of these tragedies. And now, when we look at the potential long-term ramifications of Hurricane Harvey and Hurricane Irma, we can look back to Hurricane Katrina to inform our expectations. In a lot of ways, Hurricane Katrina was much more severe, but even then, there was only a regional impact to GDP. We didn't see that marker fluctuate very significantly on a national level. Oil and natural gas prices spiked as production and transportation went offline, but they normalized within 3 to 5 months. And again, we're already seeing that happening as the refineries in Houston weren't destroyed, were simply shut down for the most part. So the most important part is that if you are directly engaged in the Southeast, if you are directly engaged, either sell into or buy from Houston, Louisiana, those areas, you have to account for near-term supply chain disruptions, higher prices, longer purchasing times, longer lag times. But that's not just something you have to do in response to hurricanes. You have to account for that now and later. You have to look for ways to diversify your purchasing pool, see if you can't buy it from the center of the country that are less likely to be hit by these large tropical storms, and really just steel your supply chain against these hurricanes. Weathermen are often reviled as being the only forecasters with a worse rep than an economic forecaster, so I'm not sure that even they can tell you when the next hurricane is going to hit. I definitely can't. But what I can tell you with certainty is that it will hit again. And if you're not accounting for that downside risk, if you're not accounting for that black swan, which will happen, then you're going to be taken by surprise every time and lose out against your competitors. Speaking of oil price shocks and energy prices, here I have kind of a spaghetti chart of growth rates for a variety of different major commodity prices. Copper, zinc, aluminum, lead, tin, steel, all of the major headline metal prices that you see. And again, they're all above the year-ago level. Copper rising the fastest, up 37.2%. Compared to the same time period last year. Steel is only up about 3% compared to the third quarter of last year. Again, but all positive indicators. A lot of the weakness in metal prices that we saw was driven by steel earlier this year and in late 2016. A lot of that was due to Chinese dumping, where the government was essentially subsidizing costs so that Chinese manufacturers could dump this low-price, low-quality steel in our economy at prices that we were never able to compete with. The U.S. government responded relatively quickly, levying some significant tariffs and taxes against them. And since then, we've seen those costs equilibrate, and again, that general significant rise in metal prices. Importantly, you can see that they have crested that ridge. They have transitioned to that phase C slower growth period. So what that is saying is that the majority of the price rise that we expect to see, we've already seen in the first half of 2017. The second half of the year, followed by the first half of 2018, is still going to see an inflationary metal pricing environment, but it's going to be at a much lower, a much depressed pace compared to what we saw over the last 6 to 9 months. Oil prices are no different. Again, they've kind of oscillated and seen some weakness over the last 2 or 3 months. A lot of that has been due to uncertainty and structural factors regarding very high inventories that we have. But rise has taken hold once again. And as you see in this orange forecast line, that's our median expectation. We expected this green line to rise and oil prices to generally trend along the $53 to $55 range over the next year. Now, this is going to be a volatile period as OPEC and Russia wrangle with the pricing environment and try and decide whether or not to draw back on cuts. So you may see prices fall back into the $48, $49 range. You may see them jump to the $56, $57 range. But in the long term trend is suggesting that, again, $52 to $55 is where oil prices are really going to equilibrate during the next year. We've seen some rise in natural gas prices as well, especially compared to 2016. They've been relatively flat for the last 6 months or so. We expect mild rise over the next year through mid-2018. But again, it's going to be more of a volatile plateau where it'll jump up, it'll fall down, it'll jump up. But again, generally trend around where energy prices are trending at the current time. And now, this is a confusing chart with a lot going on right now, so I want to kind of break it down for you. On the bottom of this chart, you'll see the dark blue kind of bar chart. That is our data trend, our annual trend, our 12-month moving average for average U.S. oil and gas extraction. And then up top along that zero line, we have the rates of change, so the annual and quarterly growth rates. You can see on the data trend level, there has been some rise in oil and gas extraction, and actually both for oil extraction and gas extraction separately. However, if you look at the rates of change, they still are below the year-ago level. We're seeing some upward business cycle pressures from the 312, suggesting that we will see a transition to phase B imminently, and we expect accelerating growth to occur through about mid-2018 as far as oil and gas extraction goes. Again, this is mostly responding to the moderation in oil and gas prices that we've seen since the crash in 2016, and there's nothing disruptive or that is jumping out within the mining and gas sector that we're going to be concerned about right now. The fundamentals really are saying about another year of cyclical rise is likely. And what are the main drivers of that recovery? Here you can see titled The Global Oil Market in light blue, and it's a little difficult to see. Again, this kind of concave curve that fell down through about September of 2016 before rising. That's U.S. oil production. And then the dark blue, kind of running opposite of that, making this X, is the major OPEC 12 nation oil production. You can see that, again, we saw that oil price crash in 2015 and 2016, and you can really see how that was driven by OPEC flooding that market as that blue line rises. And at the same time, U.S. producers responded by cutting back and trying to shield themselves from those low prices. Importantly, though, that trend is reversed. Once again, that light blue U.S. line has upward passed the OPEC line. And OPEC, which has been struggling to get their cartel to act in unison, has lost a significant portion of their market share in 2017. And what this is going to do is shield ourselves from much of the volatility that we saw coming from OPEC in 2015 and 2016. And this is an important factor because it corroborates our expectation that we're not expecting another flux like we saw in 2016. We're not expecting that 50%, 100% decline or growth. Things really are going to be mostly steady as they go in the oil and gas sector, with flat to mildly rising prices over the next year. And now when we talk about rising energy prices, we talk about economic growth, we're talking about rising metal commodity prices. Well, as prices rise, so do price indexes. Here we have the U.S. Consumer Price Index in orange. That's the most commonly cited measure of inflation that you'll see in the news or that the Federal Reserve watches when they're thinking about interest rates. And in blue, we have the U.S. Producer Price Index. The Producer Price Index is up about 3%. The Consumer Price Index lagging a little bit behind at about 2%. As far as you all are concerned, the primary metric that you're concerned about is this Producer Price Index. This is what describes the fluctuation in input costs for raw materials and producers that use raw materials as inputs. So whenever you see the Producer Price Index rising by 3% or 2.5%, that's suggesting that your profitability is going to be impacted around 3% or 2.5% if you don't account for that. Again, you can see that we saw that spike a few months ago. So the fastest price rise, again, we saw earlier this year, but we do expect inflationary pressures to persist throughout 2018. Again, we've seen rising labor costs, rising wages, and now we're looking at rising inflation through 2018. And all of that is going to impact your bottom line. All of that is going to threaten your profitability, and you have to take action if you haven't already by the end of the year in order to take advantage of the economic growth that we expect in 2018 without losing out to rising wage and labor price and input cost pressures. And again, I mentioned, the Federal Reserve does watch these inflationary metrics very closely. As of 2Q17, you can see these dots here are each of the members of the Federal Reserve Open Market Committee, which is the committee that is responsible for setting interest rates in the U.S. And you can see their expectations for the end of 2017, 2018, 2019, and kind of 2020 and beyond. You see, we've expected miles rise in about the 1.25% range in 2017, general rise in 2018, followed by a cluster around 3% in 2019. As of September, their most recent expectations, you can see in orange, they really haven't changed. Again, we've seen consistent economic signaling from the major leading indicators, from the major inflationary indexes, and because of that, the Federal Reserve is basically convinced that as they unwind their balance sheet and kind of restrict the flow of money in the economy, they're also going to be raising these interest rates. And we expect these interest rates to hit just about 3% by 2019. And then beyond, too. In the long run, you can plan as far as the Federal Market or Federal Open Market Committee is concerned for about 3% borrowing costs. Now, that sounds like some kind of financial wizardry that we all shouldn't be too concerned about, but again, coupled with inflation, coupled with rising labor costs, coupled with higher costs of doing business, all of those things, again, are going to impact your bottom line. And so if the labor costs didn't convince you, if the commodity price and input costs rise didn't convince you, then hopefully this rising interest rate environment, this higher cost of doing business environment will convince you that you do need to shield yourself against these higher prices. And now we're going to jump into more of some microeconomic industry-level trends as we move away from the broader strokes macro. Here we have the U.S. primary smelting and refining of copper production index. You can see that 12 MMT has turned over. The annual growth rate has ticked down below the zero line. We have fallen into phase D recession. We're down about 0.5% year over year. And we'll likely see this phase D trend persist through 2017. Decline will be mild. We won't see anything as severe as any of the last two recessions that we saw in this industry, and will likely be down about 2 or 3 percentage points as opposed to the about 10 or 15 that we normally expect to see. Again, this is a strong industrial growth environment, and that demand for metals is going to help mitigate a lot of the weakness we see before rise takes hold again in the latter half of 2018. Here we have the U.S. Copper and Brass Producer Price Index, again a measure of inflation and a measure of input costs. You can see that it is rising. It's currently up 13.9% year over year in phase B. We expect it to peak in the end of 2017, finishing up 16.3%. And pricing pressures are going to ease throughout 2018, but inflation will persist. Remember, as you see that phase C growth rate going down, that just means that the inflationary pressures are going to be less severe. So again, for those of you directly involved, this is, again, one of your warning bells that yes, prices are rising, and yes, you absolutely have to do something about it on a macro level and a micro level as well. Here we have U.S. total power facilities construction. Again, currently in phase C, up 1% year over year, but we have seen that 12 MMA curl over. We have seen some massive decline taking hold. And our analysis suggests that we are going to see a mild phase D by year end. Similar to what we saw with copper and brass smelting, it's not going to be anything severe, just a few bips compared to what we saw in 2015 and 2013. But it is likely to know that you won't see any significant economic tailwinds from the energy sector as far as construction inputs go through at least the first half of 2018. But that's not telling the whole story. Here you can see we have U.S. coal consumption for the electric power sector. It's currently in phase B, up just about 4% year over year, and we expect that to curl over imminently before contracting through 2018. Now, those growth rates can be a little misleading when you're saying, yeah, there's some positivity there, nothing to be concerned about. If you look at the, pardon me, if you look over on your left at the data trends, you see that we are at basically record low levels right now, and we'll return to record low levels by mid-2018. And we're not going to see significant rise on a 12 MMA basis in coal consumption for the long term. You can see we have for the next 2 years through 2018, but this is a long-term trend. And that's because the energy sector is changing. It's been very dynamic over the past few years. In a lot of ways, that dynamism, is accelerating. This year, natural gas replaced coal as the U.S.'s top energy source for electricity production for the first time in history. And that's because gas is cheaper and cleaner. We have the infrastructure in place to move gas around, which a lot of developing nations don't. The prices are encouraging consumers to go for gas. And again, as we become, as a society, relatively more aware of climate impacts and the negative effects of burning fossil fuels, we've really seen the benefit of relatively cleaner gas as opposed to coal. At the same time, again, with the rise of environmentalism in the U.S., renewables market share is rising. Again, has reached record high levels. That trend's not going anywhere. The cost of making these renewables, of hydropower, of air power, of solar power, is only going down. And as that happens, hydro and solar and wind is going to be more and more competitive, and again, see that market share rise. Both of these are going to continue to put downward pressures on how much coal we burn in the U.S. But that's not to say coal plants aren't dead. They're not going anywhere, especially in foreign markets. They'll maintain a smaller footprint, but if you look to Africa, if you look to Southeast Asia, China, they still heavily rely upon coal. And And so if you sell into these markets, if you service these markets, and you also have a global footprint, it's time to start transitioning away from coal plants in the U.S. Toward the more renewable or petrofuel area of power plant production, and move your coal sector, again, Asia, some parts of South America, most of Africa. That's where the growth is going to be for coal. Moving into the construction sector, here we have U.S. private non-residential construction. This involves everything from offices to hospitals to hotels to, again, power plants to manufacturing plants. Really everything that you don't live in or that is publicly funded is what is included in this metric. Currently up just about 5.6% year over year. It's in a phase C slower growth trend, which again, normally a little concerning, but there's very little threat of recession here. We expect some further deceleration through the remainder of 2017 before some strong phase B transition takes hold in 2018. This is going to be a fairly positive growth sector through at least 2018 and moving into 2019 as well. So if you sell into this market and you've been facing rising costs, the economic environment is such that profits are up, and if you sell into the sector, you likely won't be met by too stiff of a pushback compared to other weaker sectors if you do try and raise your prices. Conversely, here we have public construction spending, phase D, recession down 4.0% year over year. We expect that recession to persist through the remainder of 2017. And the growth that we do expect to take hold by the end of 2018 is going to be very mild. You can see 2019 will finish up just about 0.3%. A lot of this weakness has been politically driven. Again, as the House and Congress wrestles over budgetary constraints and the fiscal cliff, and as we look at whether we're increasing taxes or cutting taxes or increasing spending or cutting spending, all of those politically motivated factors are very much still on the cutting board. They are very much in flux, and because of that, there has been a large pause in large publicly funded construction projects as essentially different organizations try and figure out how much money they're allowed to play with over the next 4 years. That's likely going to persist through at least 2017. We normally expect to see like 6 to 9 months before any major budgetary or tax reform is passed. And after that, it normally takes at least a year for any of those bills that were passed to really trickle into the economic data. So that brings us into late 2018, early 2019, before we see any potential headwinds from any spending bills that might be coming out of the House or coming out of the Senate. Housing starts are, again, another positive sector of the economy. Recently suffered a soft landing, or benefited from a soft landing, I should say, and have transitioned back to phase B, accelerating growth. And again, on this chart down bottom, you can see the 12 MMT, so the total amount of houses that are being started in the U.S. Where up on top, you can see those annual rates of change that we look at. Again, the 12 MMT is the highest in almost 9 years, a very positive factor for the economy. And again, all of those positive consumer trends, higher wages, higher disposable personal income, everyone has a job. That's helping people to buy houses, right? The correlation there is pretty cut and dry as far as we see it. We expect that 12-12 acceleration to last through early 2018 before curling down at the tail end of 2018 into 2019. And again, this supports our expectation of some of the industrial weakness that we expect in 2019 being driven by a softening of consumer trends, a pullback in spending, some, those wage pressures disappearing. And the housing market, as far as we see it right now, is corroborating that expectation of accelerating growth in 2017 and 2018. And some weakness in 2019. But obviously it's a big country, and what's happening in the Northeast might not be happening in the Southwest, and so we've broken it down by region for you. This might be a chart you've seen before. I like to keep it updated because it does help give some nice insight. Here we have regional single-family housing permits growth rates. The Northeast and the Mountain region, phase B, accelerating, that's great. Everywhere else is in a slower growth trend. Again, it's curling down. We're not likely to see any significant recessions here, but we have seen some data trend decline in the plains and the Southwest. So if you're selling into those areas, that's going to be the major concern for single-family construction in the U.S. is that plains and Southwest region. Multifamily is more of a mixed bag. You can see Mountains Pacific are in Phase B, great if you're selling into that area. The Northeast is in Phase C and declining on an annual basis. Not a terrible environment right now, not great by any means, whereas the Southeast, Great Lakes, Plains, and Southwest are going to be risk factors through at least the rest of the year. And now, again, I want to kind of zoom out with our lens a little bit and just briefly touch upon some of the global trends that we're looking at. You'll see kind of these multicolored charts ranging from red to green that I have here for various different regions of the world. And this is showing growth rates, more positive in green, less positive or negative in red. And these are all industrial production growth rates. So again, just a broad, vague capture of economic activity. You can see that growth has finally, after a tough year and a half, pretty definitively taken hold in North America. Canada up 4%, some great growth rates. The US up about 1%. Mexico's down about 40 bips. We do expect it to transition to Phase B, accelerated growth by the end of the year. But a lot of those political pressures that I talked about, Mexico is facing very much so. Any stricter legislation on immigration or penalties on outsourcing in the U.S. are really going to hinder the Mexican economy, which has obviously benefited greatly from outsourcing their labor and taking a lot of the work that has been produced in the U.S. So any changes there could drastically change our outlook, as well as any changes to NAFTA, the major trade bill, which again has benefited pretty largely Canada, the U.S., and Mexico. But if border tariffs are imposed on a national level, Mexico will likely be the primary loser compared to the U.S. and Canada. South America, again, very much a mixed bag. Peru, Argentina doing pretty well, up 3%, 1% for Argentina. Colombia, just about even with the year-ago level. Brazil is in a pretty deep recession right now. They're facing a slew of political issues, corruption issues, obviously the major Petrobras scandal, which is their nationalized oil industry, which got hit by the downturn in oil prices and a corruption scandal simultaneously. Brazil is not going to give you any significant growth opportunities really through at least 2018. It's going to be they have some major reforms they need to punch through before their economy gets back on their feet. Europe, much brighter picture. You can see a lot of green here. France is kind of the underperformer of the major Western European powerhouses, up 0.8%. We expect them to kind of flatline through the remainder of the year. They're struggling with strong labor unions, some really anti-competitive labor laws that really give some significant protections to their workers, as well as a very strong euro, which is hurting them against Eastern Europe. But Germany, the UK, both doing pretty good. Sweden, Norway's down 2%. Again, not surprising given that we're still seeing those recovery trends take hold in the world's major petro producers. Eastern Europe, you're seeing much higher growth rates, 6%, 5%, 8%. That's to be expected. They are a less mature industrial region of the world, and because of that, we expect to generally see much higher growth rates on the front side of the business cycle as they essentially try and catch up to their Western partners. Overall, though, if you're selling into Europe, it's a pretty good time to do it. The demand is there. They're buying, they're selling. The economy is chugging along pretty nicely and will do so throughout 2018. Major Asian nations also looking good. India up 3%, China up 6.5%. Thailand kind of faltering, but overall, as long as China and India are doing good, their neighbors are going to be doing good as well. Again, our outlook very much mirrors that of the U.S. Accelerating growth through the first half of 2018, some downward pressures throughout the second half of 2018, but nothing major. Expect persistent demand from most major Asian nations over the next 3 years. You can see Australia just up 10 basis points, basically flat with the prior year. They've been significantly hit by the downturn in coal demand as a power source. They are the world's major coal exporter, and because of that, they're going to have some work to do before they get their mining sector back up and running in the second half of 2018. So we've seen a lot of positivity from the U.S. economy abroad as well, but there are still some lingering concerns that we're looking at. Potential return to a strengthening dollar. The dollar is basically historically strong right now, but it has slid a little bit in recent months, which has given a nice reprieve to U.S. exporters as they become more competitive on the global market. But that reprieve is likely to be just temporary. Global fundamentals suggest that a return to a strengthening dollar is likely, or if not a strengthening dollar, it will at least remain flat and remain as strong as it has been, which again is going to keep us basically a little anti-competitive as far as exports in the global stage go for the next 6 months to a year or so. As we saw earlier, those relying on commodity prices, primarily petroleum prices, they're going to have a tough finish to the year, a tough start to 2018 before they get back on their feet and that pricing environment really firms up. Labor shortages in the U.S. Again, as I said earlier, new job openings are outpacing how fast those jobs are being filled. Wages are rising. You have to deal with that. And ultimately, it's primarily impacting the skilled trades, your electricians, your plumbers, your welders. That's where a lot of the shortages are going to be in the industrial sector. And again, that is a long-term trend that we are looking at the U.S. that will not diminish for at least the next year. Finally, we've been monitoring some what we consider lingering global uncertainty, which sounds very vague, but what we've seen in the U.S. with the potential breakup of NAFTA, what we saw with Brexit, what we saw to a lesser extent in France and Germany with a kind of national-centric view, a breakdown in global trade. Yes, that has its benefits, but overall, we see potential returns to nationalism and a breakdown in globalism as a drag on most of the major economies in the world, the U.S. and Europe, China especially. So while those haven't come to fruition yet, if those political kind of winds shift away from globalism and back toward nationalism, we'll likely see a more severe 2019 recession and mildly depressed growth rates in 2018. And finally, most importantly though, as we talk about RISE, you have to know what to do to prepare for expansion throughout 2018. First off, know where you specifically and your markets are in the business cycle. You can look at the major industries and how they relate to U.S. industrial production, but what you really want to do is do a lead-lag analysis on your industries and your primary markets to find out how you, as opposed to your market, compares to the industrial sector. How you can do that is by following the must-watch leading indicators. You can find that in our quarterly report. That's the PMI, ITRLI, housing starts, inflation, bond market, etc. You can also follow those in the ITR Trends report if you're a subscriber on a monthly basis. Budget for continued expansion through 2018. Again, we're going to see those growth rates start to tick down in the second half of 2018, but the important part is to not cut back on expansion, not cut back on investment until you actually see your numbers declining in the latter half of 2018. Plan for it to be a good year, lead with confidence, and take advantage of that rise. Otherwise, you'll be missing out on market share, and you'll be missing out compared to your major competitors. Invest in operational efficiencies. Productivity has to match wage increases, and not just wage increases, but higher borrowing costs and higher commodity prices as well. Again, people are going to push back on price increases. That's just the reality of doing business. So the fact of the matter is that if you are charging more for your inputs, but you're not charging more for your outputs, you're going to lose money, and you have to start doing more with less. Whether that is cutting back on your labor force by cross-training, or increasing the productivity of your workers with tech, you have to find a way to invest in your operational efficiencies and get your numbers up while prices rise. And finally, that's all I have for you today. I'm going to kick it back to you, Courtney, and I'm more than happy to take any of the questions that you may have that you've submitted through here.
Thank you, Chris. Once again, please submit your questions using the tab on your webinar toolbar. We already have one. Chris, how much of the 2.9 PPI is driven by commodity versus other inflammatory drivers?
Now, I don't have an exact number for you, so I'm going to talk qualitatively here. The lion's share of the PPI, with kind of pulling a number out as a best estimate, is most likely going to be 2/3. Labor costs and energy costs factor into that as well. But obviously energy costs are a factor of commodity prices. So primarily it's going to be the more commodity-driven producers that are going to feel the full effects of that 3% growth.
Okay. Another question, as this is October, what should we be looking out for the rest of the year? Or are there anything major that could happen to change your prediction?
So we're not looking at any major risk factors right now for 2017. Again, it is October. We're not even a quarter out from the end of the year. The economic data is pretty entrenched right now. There's a lot of momentum behind the rise that we're seeing. And as I mentioned earlier, a lot of the risk that we're looking at to our forecast from a deviation standpoint is found in that Purchasing Managers Index, which suggests, if anything, an upside deviation in the first half of 2018. As far as areas to watch go, really it's going to be moving into the second half of 2018, mid-2018 or so. That's when you really want to start watching for risk factors, primarily if you sell into industries that are heavily consumer-driven. Again, we expect the consumer to remain pretty healthy through 2018, but that'll vary on an industry-by-industry basis. For example, we've been monitoring some risks in the auto market, high delinquency rates, a crazy amount of highly capitalized, overly capitalized lending is going on. It's almost reminiscent of what we saw in the housing market in 2007. So those weaknesses are something we're watching. But again, there's enough momentum behind that industry to carry it really into mid-2018. So while it's always important to watch for risk factors on a company level and an industry level, aside from managing your labor force, managing your employee retention, you're really making sure you have the people to meet this economic growth. We're not monitoring any major risk factors over the next 6 months or so.
Okay, next question. Is the rise in consumer debt, particularly credit card and auto loans, a major concern to limit the ability of the U.S. consumer to drive the overall economy?
No, it's not a major concern. The rise in debt that we've been seeing, especially credit card debt, is a pretty normal rise in debt that we see during periods of economic expansion. It's nothing concerning right now. It's well within healthy levels. Auto debt is a different factor, likely not enough to affect the overall U.S. economy as a whole. But again, if you sell into that market, that debt is starting to look very concerning as we move into the second half of 2018. I know we're up here in New Hampshire, and they're advertising on the radio something like a $45,000 loan if you bring home $300 a week after taxes. It's insane how overly capitalized that area is. So for the auto market, yes. For the overall economy, no. I will have a caveat there where if credit card debt, if personal loan debt, home loan debt does start to accelerate as we move into 2018 faster than it is now, and the savings rate starts to get hurt because of that, that could make consumers marginally less able to deal with the slowdown we're looking at 2019, and that the trough of that recession could be mildly lower. But overall, consumer debt isn't going to be a factor in 2018.
Okay, next question. Mexico shows negative growth, but a short time ago there were some FS showing 5 through 9% growth in electronics and automotive. So is the negative Mexico growth vastly different by industry segment, or do you see negative across the board? Can you provide any detail or view by segment in Mexico?
So you're correct. It absolutely varies pretty significantly by segment. I don't have those in my head right now, so I don't want to mislead you with my best guess. But if you either forward your question to Courtney after this, or if you get in touch with me at csteele@itraeconomics.com, I'd be happy to give you a little breakdown of some of those industries.
Okay, so we're going to wrap up. Thank you, Chris, and thank you to IT Economics, our sponsor ABC Metals, and to everyone who's joining us this afternoon. If you have any additional questions, please feel free to email me and I will pass them along to Chris. Have a wonderful rest of your day. Thank you.